A car used to mean freedom. Now it's a $50,000 debt sentence with wheels. We didn't just make cars expensive, we built a bubble no one's ready to pop. Hey, this is Coinrad, and today we're counting down 5 reasons the car market's gone completely off the rails, from the small ripoffs to the system-wide scam that could blow up the economy. Number 5, the insurance explosion. Let's start with the one you can't escape: insurance. Premiums are up more than 20% in just a year. Why? Modern cars are packed with cameras, sensors, and electronics. A small fender bender that used to cost $500 now costs $3,000 because you broke a vision module. Insurers call it higher claim costs. Drivers call it, "Why is my account empty?" And here's the twist. Even if you already own your car, you're still paying for the bubble. When vehicle values rise, insurers raise rates to match the risk. So your costs go up for a car that didn't get newer, better, or safer. It's inflation with a smiley logo and a renewal email that ruins your morning. Number 4, repairs and parts cost a fortune. Mechanics are booked out for weeks, parts are scarce, and labor costs have exploded. A repair that cost $400 a few years ago can now hit $1,200, if you can even get the part. Cars used to lose value as they aged. Now they age like fine debt, more expensive with time. And that's the problem. When fixing an old car becomes impossible or unaffordable, people are forced to buy new ones. That means steady demand and prices that never fall. It's like every part of the system agreed, you're not driving your way out of this. Number 3, dealers turned into speculators. During the pandemic, dealers discovered something darkly magical. If you pretend there's a shortage, people will pay anything. So they started hoarding inventory and slapping market adjustment stickers on windshields. $10,000 above MSRP, no shame attached. They blamed supply chain issues, but somehow the shortage never went away. By 2025, many lots still look half empty, not because they can't restock, but because scarcity sells. Dealers learned to treat cars like commodities. Why move 10 units when you can move 5 for double the profit? The car lot isn't a marketplace anymore. It's a casino with better lighting. You're not buying transportation, you're bidding on desperation. Number 2, the loan trap. When cars got too expensive, banks didn't panic. They innovated. They turned 5-year loans into 7, sometimes 8. That's not financing. That's a relationship with depreciation. Average new car payment? Around $750 a month. Used? About $550. And millions now owe more than their car's worth, trapped in the cycle of negative equity. We used to joke a car loses value the moment you drive it off the lot. Now it loses value before the first payment clears. And when interest rates jumped in 2024, the trap snapped shut. Refinancing vanished. Defaults crept up. For millions of Americans, the driveway became a debt portfolio. This isn't personal finance. It's systemic. The same logic that inflated the housing market in 2008. Borrow more, stretch longer, pretend it'll hold value forever. Number 1, the supply shock that never ended. Here's the big one, the foundation of the entire mess. A pandemic chip shortage crushed production, prices shot up. Then the chips came back, but the prices didn't. Automakers learned something dangerous. Sell less, make more. They realized they don't need record sales, just record margins. So they kept inventory tight, bragged about pricing discipline, and made billions while buyers paid double. Dealers followed suit, pretending low supply was permanent. The fake scarcity became real because it's profitable. That's not supply and demand. That's scarcity as a business model. The same strategy used to inflate houses, healthcare, and education, now applied to the thing that was supposed to get you to work. Here's what ties it all together. Wall Street figured out how to turn your car loan into their next money machine. Banks bundle those loans into asset-backed securities, sell them to investors, and collect the profits until the borrowers start missing payments. Sound familiar? It should. It's the 2008 mortgage model, just smaller and shinier. Except this time, the collateral doesn't appreciate, it rusts. The moment defaults rise, those fancy financial products start wobbling. And because auto debt is now over $1.6 trillion, even a small wobble can shake the system. So here's where we are. Insurance up, repairs up, payments through the roof, and an economy pretending this is normal. We turn the symbol of freedom into another debt trap, one that literally drives itself off a cliff in value. It's not just a car market problem, it's another symptom of a system that can't function unless someone's drowning. Maybe the real bubble isn't in cars. Maybe it's in our belief that everything has to make someone richer before it makes anyone's life easier. So what do you think? Are we already living through the slow crash? Or will this be the next surprise everyone swears they couldn't see coming? This is Coinrad. Hit subscribe and stick around for more stories about money, markets, and the madness they create.